Everybody, I hope everybody's surviving lockdown. Gosh, I can't believe that it's been over 5 weeks already. So Edward, Rod and myself thought we'd just put this little presentation together for you, for all you folks back at home. We just wanted to say our thoughts and prayers are with you, and we hope everything's going well. We are contacting people on a regular basis, but we thought it would be important just to keep you updated with what's happening in the markets and where we see things and trends going. So here's a quick presentation of about 20 minutes. From some presentations that we've been doing, webinars and whatever on Zoom, etc., with all the fund managers. So every day virtually we meet with fund managers and we discuss what's going on globally and locally. Let me give you a couple of slides that we've looked at. The first thing is what happened with this whole crisis. Just a quick snapshot. On the 31st, at the end of March, when the worst of the market downturn occurred, you'll see that the property sector down almost 47% year on year. That's quite striking. And then, of course, the all-share index down 18%, which is quite significant. So you can see all across the bourses here, the only thing that's making money right now is if you put your money in fixed interest, which is what we've been saying for a while. Fixed interest, certainly locally, for the last 5, 6, 7 years has been the place to be. The equity markets have not been a great place to be. So all these slides that you see that I'm doing in the presentation, if you can't see them clearly on the YouTube, we're going to be sending these slides to you as well on email, and you can go through the slides as well. But basically, looking at the numbers are obviously not that great. Of course, even in the world markets, if we look at the Morgan Stanley Capital Index in dollar terms, down about 21%. That's in dollar terms. So you can see there's a massive market sell-off as this COVID-19 pandemic started to unfold. So no real places to hide, except perhaps if you were in bonds. And of course, for those gold bulls, there was some money to be made in gold as well. And we'll run through that through the slides. But generally speaking, equities, no. Property, definitely not, certainly locally. The places to be were in the fixed interest side. Of course, there was some money to be made in global bonds. They were giving protection, but as we know, global bonds are virtually giving 0.5% to 1% returns. So not great there either. So what we've done is we've done calendar returns for you, all of the calendar returns of what's going on in the markets, and these, as I said, will be emailed. You can all have a quick look at that. But the graph tells it all. This is the S&P, the Standard & Poor's Top 500 Index. What happened in 2020? Markets were bouncing up and down, and of course we saw this massive market sell-off and this recovery. We call this type of recovery a V-shaped recovery. Now the big talk that everyone's talking about, will this recovery carry on going up, or in fact, will it go down further? In other words, it's a false recovery. Your guess is as good as any economist right now. But we feel that for now, we don't think the market's going to go up any much further overseas. And the reasons why is about 30 million Americans now have lost their jobs. So about 1 in 6 working Americans no longer have work. If they don't have work, they're not consuming, and we need the consumers to consume for the American market to work, which has a ripple effect in China and the rest of the global economy. One must remember that the Americans account for about 25% of world GDP. And for the Americans and for the world indeed, we need their consumers to be happy. So we've seen these big plunges. We've seen price earnings multiples also come down quite significantly from a peak of just under 24 to around about 18. So price earnings means, as those you don't know, your earnings going through will take about 18 years to come back. So the markets are not looking too terrible, but we don't feel that the markets are going to bounce up anytime spectacular. We don't think there's going to be a V-shaped recovery. We'll talk about that a bit later in the slides. Okay, so we think the fair value is somewhere between 2,800 and 3,000 for the markets. But sectors behave very, very differently. You'll see in America the top 5 shares like Facebook, Alphabet, which is Google, Microsoft and Amazon being one of the big ones. Those tech stocks account for almost 20% of the market capitalization of the S&P 500, just 5 shares. And those 5 shares have been boosting the S&P 500 returns. But if you had bought small cap stocks, or if you had bought Emerging market stocks, you haven't done well. So there's definitely opportunities if you pick the right shares. There are massive bargains out there, but we don't think you should be overly brave going in there. We would caution you. And it's not a time perhaps for exchange traded funds. It's going to be probably a stock picking market for now. What's happening locally in South Africa is very important. We've heard about this 500 billion rand stimulus package that's come through. Where did that come from? Did they start printing money like overseas? Well, not really. The banks have stepped in, and institutions, they're going to be loaning about 200 billion rands worth of money to the markets. Then we've really got social grants and COVID expenditure that was in the budget. That's another 130 billion rand. And another interesting one, UIF, the Unemployment Insurance Fund, they reckon there's going to be about 100 billion worth of claims being made there. And there's 70 billion in deferred tax payments, giving the taxpayer a bit of a break. So the taxpayer has been given a break. Hopefully that money will be plowed back into expenditure. So that's how the 500 billion rand is made up of. So they're not going to be printing money like overseas. We don't have the luxury of doing that. And our government's also, our Reserve Bank has been buying back bonds. There was a big bond sell-off, as you know, with us getting junked or downgraded. Moody's downgraded us, as you know, and we got junked. So if you look at the bond yields, let's go back to the US now. Overseas, if we go overseas, bond yields are roughly somewhere around 1% at the moment. 1 to 2%, if you're lucky, is a bond yield. In fact, many bonds that you buy overseas are negative. So if we take our money overseas, we all know that you're not going to make any money in a bank overseas in developed markets. Even if you go and buy their government bonds, you can see government bond yields have been dropping dramatically in developed markets. The US 10-year bond is the one we're looking at here. You're not even making about 0.5%. So their 10-year bond yield is actually very, very low. But you would have made money. Of course, with the currency depreciating the way it has, you would have made money in rand and dollar terms. In terms of our local market, our bond yield, our 10-year bond, our R186, that's our equivalent of the American 10-year bond. You can see that spiked up dramatically. Remember that inverse relationship we talked about? When yields go up, obviously to compensate you for the risk you're taking, you can lose capital. So the yield spiked up dramatically with the Moody's downgrade, which we're all expecting, and foreigners selling our bonds, and the general sentiment, foreigners rushing to get that liquidity back into their own pockets, as it were. Our yield spiked dramatically. There's the normal curve there, and then you can see in March this massive upswing, and yields spiked at almost unprecedented levels of about 11%, which is very high. As I said, if the yields go up, you lose money, and then there's a little bit of a comeback over here. So we see the bond yield roughly here as a really good opportunity. The 7 to 10-year bond yield space, as we've been saying for a good couple of years now, fixed interest and high interest bearing accounts locally still look fairly attractive, particularly when you see that our growth in our local market, our equities don't look great at all. There's a couple of pockets, as I said, of standouts. The rand hedges have done okay, but for most of us, particularly pensioners, who are looking for fixed interest, this is a good space. We think this is a good opportunity. In terms of the big question that no one can answer at home, we're all feeling a little bit poorer because of what's happened with the rand dollar. Well, let's see what happened there. That's 20 to the dollar, that's 18 to the dollar, 16 to the dollar. You can see that the rand dollar spiked up almost to, it went over 18 at one point. This gray line shows you where the fair range is. So the estimates of what we call purchasing power parity, people often refer this to as the Big Mac. What can my rand buy for a Big Mac burger in South Africa versus a Big Mac burger overseas? And it's quite a funny way of measuring things, but it's actually quite accurate. It's how far does my money go, my rand go for my dollar? And we feel that fair price is somewhere around 15 to 16 to the dollar. At the moment it's trading well over 18 to the dollar. So don't be surprised if the rand does come back briefly for a while. We've had a lot of selling off of our assets right now, bonds, etc. But if you rush overseas, what are you going to get for your money overseas? You're going to get no interest. So you're forced to go into the equity markets overseas. You're forced to go into the bond markets where you don't get much. So you might be finding that people might come back and start buying rands again. Obviously, let's see how that happens. Historically, that's what happened. There's a panic selling and a strengthening. Selling, strengthening, selling, strengthening. And now it's jumped all the way there. There is a possibility that the rand could snap back some of its value. Let's see how that unfolds. Right, in terms of fund managers, I thought it's quite important. So we're going to take 5 or 6 big fund managers out there that people would typically be exposed to. Some of the largest fund managers. Let's start with Alan Gray and Prudential. Prudential Inflation Plus, one of the flagship funds of Prudential. It's a low equity fund. You'll see this fund did minus 13.7% over 1 year. Over 3 years, minus 2.5. It's barely made money over 5 years, 0.4%. In fact, 7 years, only 3.9%. And this is a low risk fund. It only has 22% exposure to equities. So while we're highlighting these funds, is we've sold off significantly 3, 4, 5 years ago out of these type of funds. We've downweighted them tremendously. We sold out of funds like Alan Gray, one of the biggest the biggest fund manager in South Africa. You can see their flagship Alan Gray stable fund, which is supposed to beat fixed interest plus 2%, only, and I say only, over the last 5 years gave 5.3%. You're better off in fixed deposits. Even over 10 years, it only gave 7.2%. You would have been better off, as I said, in high interest bearing accounts. So you can see it really battled in the last year, minus 7.4 and minus 9.5. So people will ask us, why a couple of years ago did we sell out of these type of funds? We don't want people to invest in value funds at the moment. The style is not conducive for this type of market. You get caught in what's called a value trap. You're buying undervalued shares, etc., like construction stocks, and you're buying perhaps banking stocks. They're undervalued, but they're caught in this value trap, and the returns are not great. Of course, there could be a recovery coming forward in the years to come, but in current market conditions and with our socio-political scenario, very unlikely that we're going to see these come back dramatically. Fund managers like Coronation, Balanced Defensive. Edward and myself had dinner just before the lockdown with the fund managers. We meet with the fund managers. We talk to them face to face. And we said, guys, how are you managing this fund? What are you doing? This is a seasoned veteran that manages this fund. And Charles de Kock and his colleague. And you can see even there, the results have been very muted, minus 9.5%. So the average low equity fund was giving between minus 13 to minus 7, 8, 9%. Now our clients didn't experience those massive losses. And these are low equity funds, I want to emphasize it, as opposed to more aggressive funds, which I'll show you. Probably another value fund manager like Net Group, they appointed Foord as their fund managers. Again, very pedestrian returns, even over 7 years, 6.3%. You can see not great returns. 1 year 2.2, 3 years 4.3, 5 years 4.3. So all these active fund managers, even with all their bonds and gold, really struggling. I'd say in my 27-year career, I've never seen such an average return over such a protracted period. We would call this an L-shaped. There's not even a recovery. What the South African market has been doing is basically being flat for the better part of almost a decade. Let's say the last 7 or 8 years, you've just seen flat returns from the local equity market on average. So, not happy hunting grounds. Again, just to re-emphasize, 75% of our average client's money was in fixed interest. For the higher net worth clients, people that could be more aggressive, of course they had more equities overseas, they could take on more risk, etc. We'll come to that as well. A very interesting fund manager, this used to be called Investec, it's now called 91. Investec are probably one of the better ones at the moment. You can see in their low equity return fund, a low equity return fund, just to re-emphasize, according to the CISA category, less than 40% in shares. So all the funds I've shown you have all got less than 40% in the market. So 60% in fixed interest, 40% only in the market. In this case, this fund had 44% in bonds, 16% in cash, and you can see foreign equities, it had a whopping 21%. Virtually no local equities there. And this made this fund look quite reasonable. 5.9% over 5 years, 5.9 over 3, and not fantastic, but a 3.5% return over the last year. So even one of the better performers, again, cash, high income funds would have beaten this. And that is why we moved ahead of the curve. We were saying 4 or 5 years ago, we don't think there's going to be growth. We didn't know about the coronavirus or what could happen. We just felt that there was a move towards some big correction. And if that happened, we looked at different scenarios and we felt the fixed interest space was a better place to be overweight and underweight local equities. And that certainly has saved us, our clients, massive pain. And we're very, very proud of it. Ed and I looked at our numbers. We've basically maintained our capital values for all our clients virtually over the last 12 months. The average client maybe saw a loss of 2 to 3% on average. Some even made money because of rand-dollar exchange. So we're very proud of that, and it's because of the way we've picked it up. Spare a thought lastly for PSG. Some of our clients were referred to us not so long ago. We had quite a lot of people refer to us on PSG over the last couple of years. We switched aggressively out of PSG. We don't use this fund, and you can see why. Minus 15%. So this is a low equity